Hey guys, really simple setup here. This setup probably suited to someone who just owns their own owner-occupied property. So for example, what commonly happens is someone's owned their property over a period of years, maybe 5 years. Property's gone up a lot in value. So this example here, we have someone's property. It's now $800,000. It's a cute little house. That's the house they live in, owner-occupier. Some people call it PPOR. Same thing for your reference. The home loan is $400,000. How do we get the equity out of this house to buy an investment property? So first of all, the equity, basically it's the difference between what it's worth and what you owe on it. So the net value of it is $400,000. The bank, they just want to lend you as much as possible. Obviously, they've got to lend you money within the regulations. But from the bank's point of view, you haven't actually got that much lending compared to the value of the property. So standard bank rules, they will go to 80% of the value of the property. So 80% of that is 640,000. So your 640,000 is what they will lend up to. The current loan is 400,000. So the difference between that and that is $240,000. So that's how much equity you can tap out. So you can go to the bank and you can say, hey, give us some extra money. We want to buy an investment property. Generally in this situation, I've done some numbers on the client's income and figured out kind of a ballpark kind of range of what they can do in terms of investment property. So let's just say, for example, they want to get $100,000 out, just to make numbers simple. What we would then do is create a separate split. You wouldn't add on to the 400,000 you already have. I'm going to explain why you wouldn't do that. A lot of lenders these days will say, well, no, you're going to have two separate loans anyway. So let's just draw that out here. 100K. So your 100K is your deposit money for the purchase of the investment property. So let's just summarize that really simply. You've got the house you live in, you've got your existing home loan against it, you pull out some more money for the deposit for the investment property purchase. So let's go over here and go investment. So let's say I've done the numbers now and I've said, look, you can purchase for $450,000 as a max for your investment property. Firstly, a lot of you guys in Melbourne and Sydney might be going, $450, that's not very much, but actually quite a lot of properties are bought at around this mark around the nation. $450, bank's going to say maximum you can go to this is 80%. Now, a little side note here, you can go higher. It does involve things like the lender's mortgage insurance. For this example, all I'm doing is making it a bit simple. So 450, 80%, that is going to be 360 grand. And you're going to have to come up with the 20%. So that's 90K. Need 90K. Where do you get that from? You've got your 100K here. So you notice it's a little bit higher. That will cover whatever costs there are, so stamp duty. So in other states that actually might need to be a bit higher. For example, in Victoria, your costs are going to be around 20,000, so you would need 110,000. So you make this whatever the costs are to be able to pull off this purchase at 80%. Otherwise, you're going to pay mortgage insurance, which may or may not be part of your strategy. That's probably something you want to chat with definitely your mortgage broker, but whoever else you're seeking financial advice from. That's your basic setup. I get a lot of questions on, Will, why do you have these three accounts? Why can't I just have one account? Well, the reason, we'll go back to the reason you have two here, is because these are two different purposes. So this loan is not tax deductible. The interest on the loan, sorry, is not tax deductible. The interest and all the costs of this loan is tax deductible. So at tax time, all you need to do is give your accountants the statements for this, and it's easy for them to prove, especially if you get audited later on, to prove what the interest was because it's in the bank statement. The reason why you keep these two separate, these two loans are secured against your home. This loan is secured against your investment property. So the bank's not holding all of these properties against all of the loans. So putting it simply, you have more control than the bank in this situation, and that's actually the preferred way of doing things. The only other thing I'll add there in terms of having a statement that you can give your accountant, what I would do is generally when you set this up, I would create a second everyday bank account. Generally what happens is with this setup, you might have another bank account or an offset account against this property, which you're using as your everyday account where your wages get paid. I would keep that as it is, but for this investment, have another bank account, and the rent goes in, and the bills go out. Again, the reason why you want to put everything in the investment, any cost or income with the investment through this bank account, is so you could just give it to your accountant at the end of the tax year. Makes things super simple and super easy. I would say for most people, this is a structure that's used most of the time.